All right, so welcome to Around the World. Tariffs, tariffs everywhere. Did anyone stop to think? And we've got the tariff man himself up in the left throwing darts at kind of countries he wants to attack. And then everybody thinks, well, he thinks he's a 3D chess master. And we'll see who's the better chess player here. We'll talk about that in a little bit. All right. So water everywhere, and all the boards did shrink. Water everywhere, nor any drop to drink. From Samuel Taylor Coleridge, The Rime of the Ancient Mariner. Trade wars are good and easy to win. Tariff is the most beautiful word from President Trump. As history has repeatedly proven, one trade tariff begets another, then another, until you've got a full-blown trade war. No one ever wins, and consumers always get, technical term, screwed. From Mark McKinnon, the benefits of a tariff are visible. Union workers can see they're protected. The harm which a tariff does is invisible. It's spread widely. There are people that don't have jobs because of the tariffs, but they'll not know it. From Milton Friedman. So I agree with all of that, and we'll continue on from here. So let's be very clear. A tariff is a tax. It's paid by the importers. And what's amazing is that the majority of Americans, when asked what's a tariff, couldn't actually tell you. 23% just said, I just don't know. The other 35% were just wrong. And they believed the nonsense from then candidate and then ultimately President Trump, saying that they'll be paid by the other countries. They never are. Ultimately, it's a tax imposed by one country on the goods and services imported from another to influence that country, raise revenues, or protect competitive advantages. Now, tariffs create distinct winners and losers. They're basically, and for the most part, generally anti-free market. So the winners of higher tariffs are domestic industries that would be uncompetitive on world markets. So basically, you can't do it on your own. It's kind of like the Anthropic guy the other day when DeepSeek came out. He's basically, making his product toast. He said, well, we need government protection. We need to put up barriers. No, you need to get better at what you do, hire better engineers, do a better product. Workers in the domestic industry, clearly, this is all about labor unions. Not all about, but a lot of it is ultimately about labor unions and the money they pay. Government tax revenue increases by a small amount. And this is a big point, that everyone's talking about how much money they're going to make. At the end of the day, it's a small amount relative to the overall damage that's done. And not that, billions of dollars is a small amount, which we'll talk about in a second. The losers, foreign exporters, clearly, they're not going to sell as much. Domestic consumers who pay higher prices, because ultimately the costs are passed along. There's a great chart that I didn't have time to put in today, but I saw it earlier today that showed that the CFOs basically said in a poll, they actually admitted, yeah, we're going to pass the price along. Domestic industries who see lower demand due to more spent on imports, and domestic exporters who experience retaliatory tariffs. So this is the problem, is tariffs beget tariffs, and tariffs beget more tariffs, and that leads to trade wars, and no one wins wars. So in the 1800s, tariffs were actually widely used, and it was a very protectionist environment. Presidents ran on protectionist platforms, and these last two of the century, Harding and McKinley, Grover Cleveland and McKinley, they were very much in favor of tariffs. And Trump actually points to McKinley, talking about how great his administration was and how wealthy the country was at that time because of tariffs. And again, I think there's a lot of conflation of the issue as to why everything was so rosy back then. And as you can see, the general direction of tariffs even up until that time, was pretty much straight down. So it was the reduction of the tariffs that was probably having the positive effect, not the increase. Hoover was decidedly undecided, but still became famous for being the president when the debacle that was the Hawley-Smoot tariff bill was promoted, and essentially plunged us into the Great Depression. And again, there are those that say, well, this happened after the Depression had already started. Well, that's technically true. It came in 1930 instead of, the crash of the market was in 1929. But what you see on the left-hand side is just the increase in tariff costs, basically eradicating 130 plus years of decline in a period of months, and that essentially closed off global trade, and the capital markets collapsed, and the depression, or the garden variety recession, turned into a depression. So people who try to make Smoot and Hawley out as heroes, it's just revisionist history. So U.S. tariffs had basically disappeared over the last 70 years. And that was because people realized just how dumb they really were. Tariff man, the man of steel tariffs, basically said, I'm going to raise prices faster than a speeding bullet. And on the right-hand side, what he didn't anticipate was that people would fight back. And the 2018 tariffs weren't thought out at all. At least this round, which we'll talk about, there actually has been a little bit of thought, not much, but a little bit. But the 2018 version of Tariff Man was as ugly as the cartoon. Just wasn't very smart. The Trump tariff fantasy in 2018 was that we would reshore American jobs. China's trade surplus would go away, and it would just be, roses in the rose garden. And the reality is that is exactly not what happened. The China trade surplus is actually up 3 times. Just let that sink in for a second. It's up 3 times since the enactment of the 18 tariffs. And the stock market basically doesn't like either when we announce tariffs, and what it really doesn't like is when retaliatory tariffs are announced, because ultimately that's what makes the whole thing escalate. So the general problem here is, on the left-hand side, we are a net importer, and China and Russia, and mostly Russia and Norway is about oil, but China and Germany are net exporters. And when you are a gigantic net importer and you basically hollowed out your industry and sent it overseas, you actually can't fix it, in the sense that because we put more money abroad, we therefore have to buy more goods. And so you can't have your cake and eat it too. It's an equality. And so we have to be a buyer of goods. And no matter how many tariffs you put on that, it's not going to fix it. And so you'll see that our trade deficit got worse under Trump. And then, political types would say, oh, and then it got worse under Biden. Well, that was just the follow through of the stuff that was already in place. It wasn't that there was a whole bunch of new activity. It's just there's a compounding effect of the problem. And China is actually, they're not playing chess. They're playing a different game, and they're kicking our butt, actually. So the chart on the left is just all the detail on the history of the Trump tariff fantasy in 2018-19. And it escalated into a global trade war which again, they're just no winners. And, a couple things you have to realize. This was a strategy, number one, to create U.S. jobs and lower the U.S. trade deficit, both of which did not happen. Okay. And when you do something over and over and it doesn't work and you just keep doing it, expecting different results, you probably should stop. And so on the bottom right-hand side, yes, you gained 1,000 jobs in the steel industry by putting up steel tariffs the first time, but you lost probably, and this could be a conservative estimate, 75,000 jobs lost by the people that actually use steel to make stuff. So it's never a winning proposition. It never has been a winning proposition. That's why we stopped doing it over 100 years. And I just don't understand why it's back. So the Treasury Secretary, who I like a lot, I mean, I think Scott Bessent is very, very talented, was on TV the other day, and he said, look, tariffs can be used in the three ways I talked about. They can generate revenue for the government. They can make trade fairer. There's that word, fairer. Why does it need to, how is it fairer? No, what he's talking about is if somebody's tariffing us and we tariff them, but if another country is making it less free and then we make it less free, I guess that's double negative. If we make it more or less free, that's not going the direction we want. But ultimately, then the other point is negotiation. So if all this is just negotiating, that's okay. But the real problem is, yes, $89 billion is a lot of money. I mean, I'm not saying it's not a lot of money, but in the big picture, particularly relative to our deficit, it's not, right? Deficit's running 4 trillion right now. So even with Doge maybe cutting a few 100 billion off, this is just not worth it. It's not worth the pain and suffering that it's causing. But the real dirty little secret is there is a pretty perfect, again, I'm not a statistician, but the correlation on the left is really, really high. And it's a lot of data, right? We're talking 1880 to 1909. And it basically says that labor productivity and tariffs are highly, highly inversely correlated. So the higher the tariffs, the lower your labor productivity, which leads to income declines. So the more tariffs you put on, the less well off your citizens are. And that's just a bad combination. Now, in 2018, the only people who were in favor of tariffs on the left-hand side were the steel industry and the aluminum industry. I mean, it's a pretty astonishing picture. And it was, nobody thought it was a good idea. Curiously, if you ask people today, almost half, a little over half, say, yeah, this will protect American jobs. No, it won't. The data does not support that. And it will actually hurt consumers much more than the foreign countries that you're imposing the tariffs on. Now, people actually acknowledge that. So it's kind of like holding two disparate thoughts and hoping that the one that you know is wrong actually somehow turns out to be right. It's just, it's kind of wild. Now, tariff support actually gets higher when people talk about this, that, we don't have fair trade. It's not a fair global playing field. And all these other countries use tariffs against us. There's not very much free trade out there except Canada, Mexico, Australia, parts of South America. Got lower tariffs in China than we have, but everybody else is cheating. Well, again, let's look at relative valuation in equity market, relative lifestyle, relative wealth, maybe there's a reason that using less tariffs is good. I don't know. So the Trump tariff threats were squarely aimed at China, but they really ended up mostly going after Mexico and Canada. And look, there's a lot of room in Asia, particularly, to equilibrate tariffs. India is the biggest offender on a relative basis, Thailand, but our level of trade with India and Thailand is probably not that much. The one that matters for us as exporters is really China, is the biggest consumer market in the world. Now, reciprocal tariffs, the question is, do we include VAT or don't include VAT, value-added tax, mostly a European thing, some in South America, but mostly a European thing. And Trump wants to include it, which would make the European tariffs significantly higher. It's just wrong. I mean, and this is an explanation of why a value-added tax is not a discriminatory tariff. But if you want to lump it in to make yourself feel better or more justified for raising the tariff numbers, go for it. But it's wrong. As usual, the Western press kind of misses the point. They think they're going to hit China where it hurts. The problem is China has changed. In the last 24 years, it used to be that China sent a lot of stuff of what it sent out to America. Now we're a tiny little part, sub 3%, and everything is going to other places. Now, the really smart ones would say, well, yes, but that Mexico and Canada stuff is really just a workaround to get Chinese goods into the U.S. Yep, that is absolutely true. There's a whole bunch of kind of crazy stuff where you ship the unassembled car to Mexico, you assemble it in Mexico, and then it becomes a Mexican import. So I don't disagree with that. But we set that up, right? We set up the rules to make that a thing. And so it's of our own doing. But at the end of the day, the reason this isn't going to hit Beijing where it hurts is because of how diversified they've become. Because ultimately, they, over the last 25 years on the left-hand side, have basically displaced the European mercantilists, the Germans, well, and the Japanese as well. And the U.S. has never really been a dominant exporter, right? We're an also-ran in any era. And ultimately, while Trump is targeting China, the reality is that China doesn't care because they sell so much stuff to other countries along the Belt and Road Initiative and all over Asia and into Africa that, they look at it as, you need us more than we need you, which doesn't play well in Washington, D.C., but I'll explain why later. Tariff Man is back. He now wants the highest tariffs that we've had since the 1930s. And yes, that's what sent us into the Great Depression. But no amount of tariffs will reverse the problem. We have a consumption problem. We are a consumer economy, and we like our cheap stuff. So if you raise the price of stuff, people actually will buy less of it. That's the way it works, unless you give them more money, which maybe that's why they're talking about giving money back from Doge. So the 25 tariff plan, modestly different, although many similar things, modestly different from the 18 plan, really tried to focus on the U.S.-China trade imbalances. Is it different this time? Yeah, it's different this time. I mean, tell people that they're going to have to pay more for computers and electronics and electrical equipment and manufacturing tools and clothes, and they'll rebel. And ultimately, we should be focused on increasing our export numbers into the largest consumer market in the world. That would be a better solution. So despite targeting China, the first thing he does is put 25% tariffs on steel and aluminum. Well, that goes directly to Mexico and China. And this has nothing to do with what I talked about before. This is not the assembled cars or the washing machines or whatever that, they screw the hose on in Canada and it becomes a Canadian product. These are raw materials in terms of steel and aluminum. And, the iron ore comes from Baffinland, which we own a little piece of, up north of the Arctic Circle, and comes down into Canada, gets turned into steel. And actually we get a lot of aluminum from them and a lot of steel from Mexico. But this is kind of a silly objective if your goal is to compete against China. Because what steel shows is what happens when you go from pure financial capitalism or when you are a country of pure financial capitalism versus a country of industrial socialism. So 25 years ago, China and the US basically produced the same amount of steel. Today, China produces 10 times more steel. They're the largest producer of steel in the world, and they make stuff with it, and everybody around the world wants to buy it. And we talked about last time that, they went over that same period from 1% of automobiles sold in the world to 39% of automobiles sold in the world. And they're crushing the global automotive business, particularly in EVs, which is concerning Tesla. And if you've seen any of the new BYD cars, which I saw some on my recent trip to Singapore and Hong Kong, they're unbelievable. I mean, they make a Tesla look like a Prius. I mean, they're crazy. So the China current account surplus and weak renminbi give them really an unassailable advantage. Some have said that the largest macro imbalance in the world is the persistent undervaluation of the renminbi. And, in 18, they tried to label China a currency manipulator and tried to stop them from devaluing the currency. And so they obliged, and they strengthened the renminbi for a few months. But it's basically been in free fall. And a weak currency gives them a huge advantage in the mercantilist state, which is why Volkswagen and Porsche and all those companies are just getting their butts kicked. So the Mexico-Canada tariffs did get delayed. They announced them over the weekend. The market plunged on Monday, was down at one point, like 2.5%, 3%. People were freaking out. And, had a call with the presidents, two countries, and they said, okay, we'll delay a month. So if they actually go into place, they definitely are an assault on automobiles. So people are going to, pay more for their cars. And yes, I said, we set that up as a workaround, I guess, for, Chinese production of assets that would be labeled Canadian or Mexican because we had the free trade agreement. So I get it. If you want to dismantle that, fine, but at least be open and honest about it and tell people, how much more they're going to pay for the things that they like paying little for. Not that cars are cheap, but they're going to get more expensive. The real problem, as I see it, is globalization or deglobalization, whatever you want to call it. Anytime you have protectionism, war, friction in global trade, you get bad outcomes. And really, since the end of World War II to today, on the left-hand side, you can see exports have had this nice, stable rise, and shockingly, not shockingly, corporate profits have risen almost in perfect lockstep. And if we reverse that, that will be bad for growth. It'll be bad for equity markets. It'll be bad for, the boomers whose 401ks will turn into 201ks again. The early economic data is not helping the tariff case. So, the there are people every day trying to get on TV saying that tariffs don't cause inflation. They actually do, and it's already shown up in the data. And it's really been trending up since the election and really spiked here in January. Inflation expectations hit a new 2-year high, and retail sales, which should have actually been good in January because we had a little better weather January than normal, plunged. So although we bad weather here in North Carolina today, which is why I don't have internet. All right. So there was a question on tariffs. Let me see if I can get that. While I agree tariffs are a horrible economic policy, we're competing with workers in many countries who seem to be willing to work many more hours at much lower wages, much poor living conditions than American workers. So of course, U.S. manufacturing can't compete. What's the alternative to tariff to support, yes, protect workers? Reason economics is called dismal science. So great question. Look, the reality is there will always be some place, whether it's foreign or within different parts of a country, where one class of people or one class of workers will tolerate poorer conditions, lower wages, because the choice is not good, right? I mean, if I was said that when I was at Notre Dame, we'd get these guys complaining that we invested in Nike. They want us to divest from Nike. We asked why. They said, oh, well, they have child labor sewing soccer balls. And I'm like, okay, but here's the problem. I mean, I've been over to that part of the world, and I've been in the factories, and part of the challenge is we're past the point where we can understand, and I'll come back to that in a second, that when your choice is starvation or arthritis, you'll choose arthritis 10 times out of 10. And so, yes, children are doing labor, but children did labor here in the U.S. in the late 1800s and into the 1900s. We used to have little kids literally chained to sewing machines in San Francisco and sweatshops. But we forget about that because now we don't have to do that. And so I'm fully aware of how, if you're comfortable, it's easy to look at that and say, boy, that's horrible. And it is, except it's more horrible to starve. So, it's like the cobalt miners in DRC. Now, everybody wants to drive their fancy Teslas, but they don't want to think about the fact that all the cobalt is located in basically war zones, and the only people they can get to mine it happen to be kids. So, people not going to drive the Tesla because they're going to protest the bad living conditions. And it goes back to Adam Smith. Adam Smith wrote this book, Comparative Advantage, and he said that every place has an advantage, whatever that advantage happens to be, whether it's natural resources or intelligence or a certain animal produces wool or lots of labor. And by using that comparative advantage and then trading, life gets better everywhere. And so I contend that, he was right then, he's still right. And I just don't see an argument that, free trade is bad, because free trade has basically an undefeated record of being better. So another question about, well, is there ever a use case or a beneficial use case for tariffs in certain industries like healthcare or national defense? And let's take the state in reverse order. So national defense is for sure an important area where you want privacy and safety and security. And my guess is that we as a country probably won't be using any Chinese drones in our defense systems. But then think about it. I mean, our defense companies rely on other countries buying our stuff. one of the one of the challenge or one of the memes I don't like it because I don't like war and all this stuff, but I like the meme when it shows the bombs going off and on two sides and says, my tax dollars, curiously, also my tax dollars. So, both, it's like the Tony Stark where he lands and he realizes that the enemy has his weapons. So I think it's odd and maybe a little bit, I don't know what the right word is, but it is odd if you think about it to say, well, we shouldn't accept anyone else's designs, even if they're better technology, but we should make everybody else buy our stuff in defense. But I can see once you get to a point of being a military superpower that you probably want your own self-contained systems. But I don't think tariffs are actually going to do that because I don't think raising the price of a Chinese drone is going to make anyone here more comfortable to buy it. Now, in healthcare, I think I see what maybe is the point. It's like if we send the manufacturing of certain drugs over to China, do we want to charge a tariff to bring them back? Well, I guess if we could manufacture those same drugs, efficaciously, safely, and for a good price, part of the problem with all of this is it's hard to find very many examples where that combination of resources, labor, energy that give you the comparative advantage can be replicated, and therefore all the tariff does is try to quote unquote level the playing field, but then that causes the retaliatory strike someplace else, which then escalates into the trade war. So rather than escalating all the prices, how about leave all the prices lower and figure out better ways to trade more effectively and more collaboratively? In some ways, I have to admire, and I don't have to like the person, but I can admire the effort by, Trump to call a trilateral meeting with Xi and Putin to try to get a reduction in defense spending. That's an interesting way to go about it. Now, people that work for defense companies don't like it, but I understand that too. All right. So, we did the surprise this year. I'm not going to do all of them, but I did think there are a number of the things in the surprises that related to this topic. I mean, one was, look, trade war was the number one concern. Inflation was the second, and rising rates, which would really be linked to inflation. Those are the three biggest fears, and all of those, I think, are related to tariffs. So surprise number one is, we're running into a minefield. Things don't play out the way we want, and the long overdue recession. Now, look, the consensus was GDP and inflation will accelerate. Okay, based on spending. And at the beginning of the year, that was confirmed. Now, all of that has reversed because spending is going the other way. That, I think, is a good thing with DOGE. U.S. GDP growth remains buoyant, but it was all deficit spending. So if we reduce the deficit spending, then growth will definitely decline, which I'll show you in a minute. Now, the problem with what was going on with J-Pow was he did cut rates. Didn't really make sense to cut rates, but he went ahead and did it anyway. And I actually know why he did it, and I'll show you in a minute. But it didn't work. So we've never had an experience like this where red line cut rates, white line interest rates go up. And in fact, it's starting to look increasingly like that double peak policy error of the 70s. Now, we're not going to do the double counting of interest rates, so I don't think we're going to get, 14% inflation. But I do think this was a policy error, so we'll see how it plays out. Now, the central banks are cutting rates globally as if the recession is already here. And just in the 6 weeks when the Atlanta Fed was saying GDP in the first quarter would be 4%, they're now hovering close to 2%. and that's going to head down further, I think. So look, if we cut the deficit by $1 trillion, that's going to come right out of GDP. And if we increase tariffs by 25% globally, or even 10%, it's going to cut GDP. So then what's the Fed going to have to do? Then printer's coming, right? The challenges are on the way. Indeed, they are inevitable. Ned Stark is right. And look, we are in a bond bear market, the third one in the last 100 years. And it's putting a monstrous pressure on funding the deficit and debt. The Fed, yes, I can fix it, or maybe not. I mean, again, it's just never happened. The blue line has never, ever happened. Doesn't make any sense that it happened, but it does at the end. I'll tell you why it makes sense at the end. So what happened is, TLT gave back all the gains that it had through mid-year last year, and everybody sold. I mean, everybody sold. And then, on January 13th, I thought it was kind of interesting. January 13th makes a Denmark 13 count. That was just coincidental. And to the day, I mean, literally to the day, long bonds have been going the right direction, and TLT's been a moneymaker. Now, I'm not saying it's the best investment in the world, but it's going in the direction that says things are getting worse, not better. So the bear and the maiden fair, the bear takes some ivermectin, has full recovery, and U.S. equities go down. Well, the economist says, heck to the no. Why even worry about anything but U.S. equities? And because of that, U.S. equities now trade at 2.5 times the valuation of any other market in the world. And the last 2 years were the best 2 years in all of the S&P. That's a pretty amazing stat. Because if you ask anyone, including myself, two years ago, would we have the best 2 years? No way. I would have said no way, and I would have been dead wrong. And literally today, no one thinks the market can ever go down again. Well, because it really hasn't gone down more than 5% at all, even in the last 2 years. Portfolio managers are now levered long, and no one is buying puts. Now, after the election, before the inauguration, there was uncertainty. People weren't sure what was going to happen. Was he going to get these things passed or not passed? And so we did have a classic sell the news kind of gave all the MAGA surge back. And then we did hit extreme fear. It hadn't been a massively good trade. And stocks are still dead money since December. But, that was a buy signal. The laws of gods and men, surprises that investors awaken from their collective slumber, see the bubble, press the sell button, and MAG stands for must acknowledge gravity. So look, the top 10 last year, 47%, awesome. Concentration never been higher, overconfidence, actually now we are exceeding the dot-com bubble, more exposure to stocks than any time, including the dot-com bubble, and adjusted for money supply growth. Now NASDAQ is higher than the dot-com bubble. We got single stocks bigger than countries. We got, the rock star, Jensen. Now here's the interesting thing. This article came out back in January, again, on the 13th. Interesting. A lot of stuff happened on the 13th. And the stock defied the article, right? I mean, maybe people knew that the article, maybe they knew about the glitches first, so you need the big red line down. So maybe the article came out late, but then it bounced right back up because, people just want to own NVIDIA. Actually, they have to own NVIDIA because it's the biggest in the index. But then DeepSeek happened. That's the second arrow. And, we lost $500 billion, and we've almost gotten it all back because, again, hope springs eternal. But if they can't deliver perfection, and if, the new Huawei chips are better than the new NVIDIA chips, which is the rumor, things are going to get interesting. So Palantir, you couldn't draw a chart to look more like the bubble. And we might be in denial finally. And then, we'll go down, maybe we touch as low as maybe that 50-day moving average, and then we'll have a return to normal, and it'll be, it's going to be great, and everything's going to be fine. This stock needs to fall a lot. I mean, a lot, but we'll talk more about that. All right, and now as watch has ended, the surprise be the long-term trend in dollar remains intact. DXY shrivels back to banner form. Look, the history of the dollar is down. Anytime you get a big run up in the dollar, it falls. Goldman says the opposite. Of course, that's what Goldman does. So you got to watch what their prop book says. My guess is they are massively short the dollar, but I have no knowledge about that. But I'll bet you if somebody does have knowledge that that's right. Hedge funds are the most bullish on the dollar because, again, Goldman's taking the other side and they always take the other side. They make money. You got to keep the dollar move in perspective. The dollar's been dead money basically for 5 years. And as we talked about last time, there are no new high plateaus, right? You don't go straight up like we did from September to January and then stay up there. So what happened? We've gone down just like clockwork. I mean, this was an easy call that the dollar was going to fall. And it has to fall. If we're going to be mercantilist, like everybody else in the world, it's our turn to go down. And now, sadly, I think Ms. Lagarde is going to have to go up. All right. So House of Black and White, global demand surges as central banks have to stimulate. Oil pumps past 100, and they don't even have to turn off supply. EIA says oil prices flat. They say everything's hunky-dory. Oil prices basically have been moving up since September. Now they're making a series of higher lows, and it needs to get back to the 200-day moving average, or this turns into an ugly pattern and we could see $45, $50 oil. But if we break back through the 200-day, I'd get excited about oil. Energy stocks, totally out of favor, huge free cash flows, but no one cares. And they got super oversold. The producers on the left and the oil services on the right. And again, that's not a mistake. That is a total V bottom, and it's a perfect double bottom. And what do I mean by a perfect double bottom? A double bottom is perfect when you get the two Vs, so one in September and one in December, but you get the second V on lower volume because all the sellers are exhausted. So this actually looks like a pretty good setup for oil stocks. And MLPs, just love them. I mean, they spit cash. They're just making so much money. It's crazy. All right, the red woman's surprise would be Crafty Christine finds a way to outcut the global central bank cutters, and European stocks outperform. Now, look, Germany found out the hard way. Trade wars are not easy to win. In fact, they're full on in recession. Manufacturing sector in total collapse. Now, Ms. Lagarde said, hey, I can fix it. I'll crank out the money printer back to maximum burr, left-hand side. I'll juice the money supply. So she's just cranking the money supply. Problem is, did anyone want to borrow money? That's the question. And she did get the euro to collapse. Went from 112 to par. But again, since January 13th, kind of weird day, it's been straight up. So maybe now she's back in the hot seat. She's got to, accept the stronger euro. That will go against my view that the European equities would be good. But look, European equities have been en fuego. They have been awesome. Even the crappy ones, right? Even Volkswagen and Porsche. I don't mean crappy like bad companies. They're good companies, but crappy meaning their prospects are crappy because China's just eaten their lunch. I mean, China's actually going to take over a bunch of Volkswagen factories in China. So, but Airbus is doing better than Boeing, and Fez is actually outperforming the S&P by a meaningful amount. I thought I changed that. Should say ECB, not ECG, not echocardiogram, although maybe it looks like an echocardiogram. Bunds got caught in the gold bond sell-off, and that is saving the banks. The European banks, this is a beautiful chart. I mean, we've owned these for a while. We talked about Deutsche Bank being a better thing to own than JP Morgan. Not that it's a better bank. It's actually a crappy bank, but they were never going to let it fail. So, all right, the big surprise was the dragon and the wolf. And again, I was just in Hong Kong and Singapore last week, and and it's amazing. I mean, it's truly amazing what's going on there. And I wasn't even on the mainland to see the magnificent cityscapes that they have built all over China. I don't know if you saw the video of the mall in China. I mean, it was stunning. I mean, it's stunning how many people were crammed in that mall. So all the talk about China being on the verge of collapse is actually kind of silly. But we thought that the Trump tariffs would not thump China stocks. Shanghai index would fly. Shanghai index was at a near 30-year low relative to the S&P. That's usually been a pretty good time to buy in. Earnings growth more than double U.S. growth, yet stocks were the same price. And yet U.S. stocks were 58% higher, best 2 years in history. That didn't make any sense. No one, and I mean no one, talking about China eked out a small win over the S&P last year. And in fact, it was off to a bad start this year. And in fact, we read the Western press that it was only a matter of time before their failed plan tanks the Chinese markets. But maybe they have a different plan that we just don't understand. I can guarantee that those journalists don't understand it. But China Treasury holdings have hit a 14-year low. They are one of the largest owners of our treasuries, along with Japan. And the only reason rates aren't higher is the UK. That ain't the UK. That is not the UK. That is Saudi or Africa or some other organization. Might even be us. Maybe we're sending money to the UK and buying our own bonds. I don't know. But that is not the UK. But it's something. And the UK is a global financial hub. So it could be Saudi or Abu Dhabi or any number of things. But that ain't the UK. But China is selling bonds at a rapid clip. Well, why would they do that? Well, if there's more sellers than buyers, then rates go up. If rates rise, then we have a problem refinancing our debt. We have 45% of the debt to refinance in the next 2 years. That gives them massive trade leverage. And this is the best part, yes, their interest rates are collapsing, but in so doing, the servicing of their debt, which is substantially smaller, gets easier, and that frees up the PBOC's $3 trillion of reserves to inject into the market. And as they, on the left-hand side, the red line is the 10-year bond yield, and the black line is their balance sheet injections. That is, again, really high correlation. And what it's saying is that the renminbi being at these super low levels is giving them a massive, massive advantage in global trade. So while we're throwing up tariffs, they're just increasing market share. So maybe we shouldn't be laughing so much. Maybe their plan has worked perfectly and we just didn't understand it because their trade surplus has gone 3x. And they're focusing on supporting innovation and consumption, which is why every announcement in AI in the last 2 months has been about Chinese innovation, and every announcement about, consumer behavior beats has come out of China, things like Alibaba and PDD. Chinese equities, whew, beautiful. That is a beautiful thing. I mean, bounce cleanly off the 200-day and are just skyrocketing, dramatically outperforming everything this year. But other than Brazil, which is a basket case, you're getting 2.5 times the growth for 40% of the valuation. What a deal. A shares, okay, they do own some less than savory companies, SOEs that probably should sell at low valuations. But the composite index is on a relative basis to where the level of the index relative to the PE, those alligator jaws or dragon jaws, are almost as wide as they've ever been. The only time they were wider was after the big recession in 2002, and that happened to be one of the best 10-year periods for Chinese equities ever. So tech stocks, way cheaper than U.S. tech stocks. Again, those are dragon jaws. And look how tight the correlation was until Biden took over. And then a bunch of nasty stuff went down, threatening the VIE structure, and people panicked. But at the end of the day, these are world-beating companies. And the terrific 10, which are the 10 biggest companies in China: Alibaba, Tencent, Meituan, Zhome, BYD, JD.com, NetEase, Baidu, Geely, and SMIC, are actually outperforming the Mag 7, which the Mag 7 are up a lot, 80%, and these are up 85. And yet everyone's long Mag 7. I mean, everyone, 56%, most crowded trade on the planet, and 4 times more or 3 times more crowded than long dollar, actually closer to 4 times. And just, 12, 13 times more than long China tech. No one's long China. Well, not no one. There's one guy who really cares. I mean, other than us around Morgan Creek, but David Tepper loves China tech. His biggest positions are Alibaba, PDD, JD. I mean, he loves Chinese tech, and he was on TV, and I love this. And I didn't put the live version in here, and Becky Quick is grilling him about, well, what's your hedge? What's your hedge? How are you going to hedge? Says, my hedge is, I don't care about tariffs. Don't talk to me about tariffs. They don't matter. China isn't playing that game. They're playing a very different game. And look at the numbers, and look at how much they're growing, and look at how much profit they're making, and look how cheap they are. And, look, President Xi embraced the tech CEOs at a recent summit last week. It's a picture on the right of the Fab, the Super Six who were there. And you got Zhome, you actually got DeepSeek, which is crazy that he was there because he's brand new. But you got Jack Ma. And the one thing about Xi that I think is interesting, I don't think I've ever seen a picture of him not smiling. The guy is always happy, and he's really, really happy here talking to the tech CEOs. And so this is a massive shift, right? 3 years ago, he clamped down on education and Jack Ma, and it was a little ugly, and probably not fun for those guys. But he seems to have gotten the memo that it's all about innovation and consumption. So that's pretty cool. All right, breaker chains. Look, as much as we love Bitcoin and think that it's a long-term hold, we do think winter is coming, that there will be another cycle, and that the second half is going to be tough. It's because, look, everyone in the world thinks Bitcoin is up only at this point. Little, small correction, and then we're going close to 150. Metcalfe's law, fair value is 95, so we're right around fair value. If you look at relative to gold, and this actually is a few weeks old, so now this number would actually be closer to 200K because gold is up so much. If you look at the power law, the dark blue line in the middle is the composite of the 4-year cycles, and then the high and the low is the kind of turquoise around it. And here we are right under 100K, kind of right where we should be. In April, and then we kind of, bounce around up and down. And then we have the final push up in October, November would be what it says. And this saying we could get to 170. And then we have crypto winter again, where we drop, probably 40-ish%. So it's not quite as big a drop this time. So Bitcoin, look, it consolidated most of last year and then had a massive run, almost like clockwork, in October, November. That is its favorite time, around Thanksgiving. It's consolidating again. So Golden Crown, surprised to be the gold prices hit 3,000. I guess I got to update my estimate. And that was because we're in a boom. That's good for commodities. Dr. Copper was doubtful, but now Dr. Copper has broken out of the triangle and basically says things are getting better, particularly in China. Gold prices glitter after a rapid move and decline in the dollar. So we had the rapid move. We just had a decline. So that is why gold prices are on the move. This is a big story about gold historically. So this is an interesting story. So last week, U.S. banks started flying gold in from London. Now, is that because they were worried that London was going to lose it? Or is it because they're worried they're going to audit Fort Knox and the gold's not there? That's been a rumor for 100 years. Not 100 years, since 50 years. So who knows? But central bank purchases of gold have been very high, not growing, but double the long-term average. And based on that, Goldman Sachs is saying, we could see, if this type of buying continues, we could see 3,300, which means I have to add another 3,000 to my price target. We've almost hit the target of 3,000. The miners, wow, free cash flow machines at the current price, they went from being marginally profitable to stunningly profitable, and still super cheap. So that should be interesting. Around the world is there for you, hedged with a capital D, digital currents. And I added a different book, Chip War. If you haven't read this, you got to read it. The next war is going to be fought with chips, not ships. And see if there are any other questions. How do the bottom of the small caps refinance and survive? Ooh, that's a great question. Look, 40% of small caps don't make any money. Not only can they not pay off their debt, they can't service their debt. So the problem you have is this question about refinancing. So how are they going to refinance their debt, particularly at higher interest rates? Many of them aren't. That's why corporate bankruptcies are nearing new highs. So a lot are going to go quietly bankrupt. We just saw Nikola go bankrupt yesterday. So I think a lot of those small caps are going away. And that's sad, but it's not, in the sense that they probably shouldn't have survived this long. And we need to clear out the bad stuff to let the good stuff grow. And no, not everybody gets to survive. It's kind of like people are all upset about cleaning house in D.C. Look, if you can't justify good outcomes with all the money you're spending, take Department of Education. If test scores aren't going up and our competitiveness isn't improving and our graduation rates aren't going up, what do we spend all that money on? I mean, it seems like a pretty good idea. And will small cap bankruptcies affect private credit? Again, great question. I think on the margin, most of the private credit managers try to stay above the worst of the riffraff, right? The really bad, low quality credit. So I think that's more, the sharky death spiral convert loans and other stuff. It's, the private credit managers, they're in trouble if we do have a recession, because then the decent companies that looked pretty good on paper in a bull market suddenly, can't make rent. I think that's true with some of the real estate stuff. So I've always struggled with private credit generally, because I feel like in many cases you're taking equity risk and getting paid debt returns. I'd rather have high quality credit and take my risk in equities, but I do think by and large the small caps aren't as represented in most of those products, particularly with the good lenders. But I think this cycle will prove once and for all that the historical smoothing effect of extend and pretend doesn't work in perpetuity. All right. Well, that was fun. That was a lot of great questions. I appreciate everybody's time, and we'll be back with another Around the World soon, and we'll be back with digital and hedged with a capital D and venture in the coming weeks. Talk to you soon.